Hello, this is Matt Russell from Daily FX Education, and today I wanted to discuss MACD and how I use it in my trading. Now, the first thing I wanted to say is that MACD is very reliable, but like with all the indicators, it's going to have its strengths and its weaknesses. So what's the major weakness of MACD? It's the timeliness of the signal. It's going to be very reliable, but that signal often occurs way too late in order for it to be useful for us as traders. So I want to discuss potential ways to sort of mitigate that problem. And it's an obvious problem of the indicator, so we have to face it head on. So the first thing I want to say, the MACD is obviously moving average based. And one of the weaknesses of moving averages in general, and why they happen to be one of my least favorite indicators, is that it's a little bit obvious. And what I mean by that is, let's say you have a currency pair that's been going down for 2 weeks straight. And then you have 1 week of price action, and prices are moving higher. Now, I can tell you, without looking at the chart, without even, with just this piece of information here, that the 5-day moving average is going to cross above the 10-day moving average. And again, it really doesn't give us any insight into trading, into finding potential trade ideas. So how do we use that potential weakness or discuss that potential weakness when discussing MACD? Because again, it's moving average based. Now, the one way that I would suggest using it, and what I do in my own trading, is I don't look at the MACD lines at all, which are moving averages. All I look at is the histogram. And if you recall from the videos what the histogram is, it's a visual representation of the distance between those two moving averages. So I want to give you like a real life scenario here in terms of finding a trade setup and how you're going to use MACD, or how I use MACD as a confirmation for my own trading. So let's say I have prices at a clear support line. I might look to enter on the long side. And let's say I have a favorable candlestick pattern as well. It's helping me to place my stop both beneath, let's say, the low wick of a candlestick pattern as well as beneath the support line. So I bring up the MACD indicator, and again, I'm not looking at anything aside from the histogram. And what I want to see on the histogram, very simply, is just some sort of momentum. Because you'll notice if you pull up the histogram right now on any chart, any time frame, but let's say it's a 60-minute chart, scan through a few currency pairs, you'll notice that the histogram, once it starts to move in one direction, it continues to move in that direction most of the time, not all the time, obviously. And the reason is that once it starts to get moving in those directions, it's going to take very sharp price moves in order to undo, if you will, an imminent cross. So all I'm looking for when I'm using the MACD histogram, all I'm looking for in terms of a confirmation is to have 3 to 5 bars on the histogram moving in the same direction. And for me, that's all I need. I'm not going to wait for the MACD cross again because the signal is a little bit too late. And I don't mind sort of, if you will, cheating a little bit, leaning in a certain direction. That's what 3 to 5 bars in the same direction helps us do. It helps us lean in the direction. It shows us that there's a high potential for an imminent cross of the MACD lines. And obviously, the more bars you have, the higher the chance that that imminent cross will occur. And it helps you to mitigate the potential weaknesses of MACD, again, which is the timeliness of the signal. Again, this is Matt Russell from the Daily FX Education team. Thank you for listening.